Greetings from Austin, Texas. I'm Aldo Flores-Quiroga, former Deputy Secretary of Energy for Hydrocarbons at Mexico's Ministry of Energy, and currently professor at the Lyndon B. Johnson School of Public Affairs here at the University of Texas at Austin. This year, the LBJ School turns 50. Through this landmark year, we celebrate the LBJ School's half-century of impact, not just within academia, but in the arena. Our new live virtual series, LBJ in the Arena, brings together world-renowned policy experts and frontline stakeholders to serve and inform during this unprecedented global crisis. Today, we will look at the impact on oil markets brought on by the decrease in oil demand due to COVID-19, and whether the new deal announced by OPEC Plus will be sufficient to bring oil production in line with demand. We will also explore post-crisis potential futures for the energy industry while looking back to history for relevant lessons learned. I have the pleasure of being joined by Marianne Kah, the chief economist at ConocoPhillips, a past president of the US Association for Energy Economics, and a member of the advisory board of UT's Energy Institute. Marianne, thank you very much for joining us. We're very happy to be with us in the Arena series.
It's great to be here. I just wanted to say that I'm not the current chief economist of ConocoPhillips, but I was in the past for 25 years. Just wanted to make sure it's understood.
And I can also add that we have become good friends already for a number of years, speaking about energy and the future of energy supply and demand. We participated together in international meetings when I was at the IEF, International Energy Forum, discussing these subjects that have become so relevant for the international energy community and certainly for the international economy. So before starting our conversation, what I would like to do is to frame part of the discussion by reviewing some of the situation of oil markets recently and how oil markets behave in the short term, and then move on to a perspective on the future of energy. And in those two parts will be how we are going to be structuring our conversation. So I will do so by resorting to a few slides that will allow us to explain this situation better. So the first part is oil prices and the search for stability, market stability. And let me use this graph from the BP Statistical Review of World Energy. This graph has crude oil prices from 1861 to 2018, both in money of the day, which is the dark green line, and in dollars of 2018, the light green line. And what I want to underscore from this graph is that this is a history of oil booms and busts, price booms and busts. This is a market that is well acquainted with volatility, with moments of crisis and successes. And we have been, if you look at the right part of this graph, already in a period of substantial price increases starting in the 1970s, then prices tanked in the 80s, then they increased in the 90s, then they declined again drastically by the end of the 90s, beginning of the 2000s. Then they climbed to unsuspected levels, at least for over a century, by 2008. Then they dropped again significantly to increase yet again and stay around $100 per barrel around 2011 to 2014. And since 2014, we have been in a situation in which prices have been very difficult to stabilize. And what has happened is that with the success of unconventional oil production, most notably from Texas, the supply of oil to the world oil market has been quite abundant. So this addition to supply from the US and also from Canada, and we could add some other successful countries working on conventional oil, like Brazil, has resulted in an oversupply of the market that in 2014 led to a drastic decline in prices, an increase in volatility, meaning that prices began varying substantially by 2015. And it took about 2 years to get OPEC members plus other countries to reach this first OPEC plus agreement to try to bring production down. And things were more or less about normal, or with the market stabilizing prices after they had tanked, and the prices were around $60 per barrel. And by the end of last year, but certainly by the beginning of this pandemic, prices began to fall drastically. So I will review a little bit more of this in a moment, but let me just tell you more about price variations and volatility with this graph. In this graph, what you see in blue is the percentage change of all prices every month. And in red, a basic measure of volatility, if you will, even the unpredictability of prices. And as you can see, I have singled out a number of events, like the supply glut of the 1980s. In 1986, that's when prices went down about 40% in the space of a year. The Gulf War, when prices increased about 40% also in a very short period of time. Then the global economic recession that led to, that's in 2008 and 2009, that led to an average decline of prices of about 30%, also in the space of a few months. And then the beginning of the crisis of 2014, 2015, in which prices began to tank. As you can see, the blue line does move a lot, and the red line presents these spikes in volatility. When prices change suddenly, there's a lot of uncertainty in the market. When prices change suddenly, meaning at a very high level, and people scramble to understand what's going on, which is more or less where we are now, although we have a better idea right now of what's going on, given the decline in demand. But there's also something interesting to note about this. Volatility is very high when prices go down substantially or when they go up. It is part of the daily life of markets. Here's another way of looking at this information. In this graph, it's the same information of price variations, but I have here a distribution, a depiction of how many variations are within a range. So for example, most of the time, about 60% of the monthly price variations are between -5 and +5%. And that's what the green bar there is, is representing. Then we have what's in green, those yellow bars. Those are -15 to +15 monthly percent variations in oil prices. And usually when we're within this range of 5 to 15%, people adapt more or less easily. There aren't a lot of concerns or protests in the streets. But when we move to these extremes moment, then there's a lot of discomfort. And you can see that the supply glut of the 80s, the economic recession of 10 years ago, the Gulf War of 1991, they are at the extremes of this distribution. They're really uncommon events. What we are facing right now is not even in this scale. This is a much more extreme event, because demand has fallen about 30 million barrels per day within the space, basically of a month. And there's a number of estimates about this. They can place it between 20 or 30 million barrels per day, but it is quite an extreme event, and it is very difficult to stabilize markets, to bring production in line with demand when things happen this fast. How extreme is this is this moment. Here is the same graph of oil prices, but now for the last 20 years. And what I am highlighting there in red is what has happened in the last few months and what happened this week, that prices for a brief moment or for a day became negative. It was a very special circumstance, but very telling also of the level, the difficulties that the market is facing right now in balancing supply and demand and in understanding where both supply and demand will be moving in the future. So what do we do when we face these problems? Well, there's two types of actions. If you look at this table, on the left, I refer to the physical market and the financial market. And policymakers seek actions and international cooperation along those two lines. If it's on the supply side, as we saw, OPEC Plus members sought to agree on production quotas to bring down production, in this case, 9.6 million barrels per day. It used to be that the Texas Railroad Commission, until the early 1970s, was ordering production quotas to producers in Texas when Texas was what we call the swing producer. If there is the opposite situation in which we have insufficient oil, there's a scarcity of oil in the market, countries also resort to strategic reserves. So they put more oil into the market. That certainly is not the situation where we are. In fact, it's the moment to build strategic reserves as opposed to release them. We have spare, and that's what the International Energy Agency does. We have spare capacity that can be used. That's why Saudi Arabia, the one country with spare capacity, has been so important in this crisis. If it's about demand, there's always a concern for greater understanding of where policy is going and policy becoming more transparent. That's certainly something that producers ask constantly, and also where the economic stimulus nowadays will be going. And then there's financial policies. It's about policy and regulation to set clear rules about how to engage in financial trading and instruments that provide liquidity to the market, but that also allow institutional investors and retail investors to participate in this type of instruments and investments, so that they can help in what we call the process of price discovery and also make a profit in the process. And there are rules for price reporting agencies that try to understand how the market is going and position limits for traders and the rest. And all of this requires a lot of dialogue and data in order to be understood. And this is what we're here today to do, to discuss these trends with some dialogue, and I have given you some data. Just one more thing before we start our conversation. Let's look at possible futures and the way the OPEC and the International Energy Agency have been looking at it. Here, what we have is world energy consumption as seen by both the IEA and OPEC. IEA is the blue circle that you can see in the graph. OPEC, well, it has the logo of OPEC. It's the two logos. The one thing to underscore here is that today, we can see that demand is going to increase by 2040 from less than 300 million barrels of oil equivalent to close to 400 barrels of oil equivalent, according to some estimates. But let me focus on the percentages associated with these graphs. If you check the graphs on the left, the bars on the left, both OPEC and the IEA note, rightly so, that about 80% of energy demand nowadays comes from fossil fuels. And this little green 2% that you see at the top refers to renewables that are not hydro. You can also check that biomass is still a very important source of energy for many, for a large share of the population in the planet, And you can also observe the role of nuclear and hydro. If we look at how energy consumption will look in 2040, these percentages under normal, if we keep doing the same, don't change a lot. We see under the current policy scenario of the IEA, 80% of energy consumption is still based on fossil fuels. And under alternative scenarios that are more ambitious for the penetration of renewables, we can see that this proportion can go down to about 60%, a little bit less, with renewables increasing in participation 17%. That's relying on the IEA scenario. And if we look at the OPEC scenario, it's similar if we keep doing the same, meaning we have about 80%, 75 to 80% of fossil fuels as the primary source of energy consumption, and renewables with about 7% by 2040. So it's an increase from 2% to about 7%. And assuming that the world is able to change the energy system so that we keep the world temperature below 2 degrees Celsius, in that case, about 50%, 56% of the energy we use would come from non-fossil fuels. So with this background, talking about the short term of the market and its extreme variation in volatility, and referring as well to possible futures, I would like now to invite Marianne to a conversation, and begin by asking her, how do we understand has been going on recently? This sharp drop in demand, where does it come from, and what does it mean for the stability of the market today?
My first comment I would make is I wouldn't put the oil market and stability in the same sentence. Since they clearly are not related, as you have shown. So how have we ended up here? The coronavirus has caused a lot of governments to have people shelter in place, and that has shut down a large portion of the world economy. And so, for example, Aldo, you mentioned earlier, we have lost 30 million barrels a day of oil demand in April out of 100 million barrels a day. It is unprecedented. You don't lose a third of oil demand. We never have. In fact, if you look at the financial crisis in 2008 and 2009, we lost maybe 1.5 million barrels a day. If you go back to 1998, you'll see a small number like that. Even if you go back to 1986, you'll see maybe we did lose 6 million barrels a day, but that was over 4 years. And so it was only 1.5 million barrels per day per year. So this is truly unprecedented. And we're not going to get that demand back until the coronavirus there's either a vaccine for it, or whether there's no more outbreaks going forward on that. Because I think we have to get the economy back running again and the disease put behind us before we can even hope to see demand increasing. We should see less demand destruction in May and June, because I guess we need to go back to the economic recovery and what is going to be the path of the economic recovery, because that's how we're going to get the demand back. And if you look at like the IMF's forecast that they issued last week, they have a 3% global decline in GDP this year, which is truly, unprecedented to have that much of a drop in 1 year. If you look at their forecast for advanced economies, you would have a drop of 6.1%. So, and that includes the US. Europe, it would be higher than that. The US, it would be a little lower. The emerging markets don't have as big a drop, but nevertheless, they're going to have to come back also. They are more likely to let people and their economies start up sooner than the advanced economies. So we need to have that come back, and economists argue about whether this is going to be a V-shaped or U-shaped or bathtub-shaped recovery or L-shaped. We saw these similar conversations back in 2008. It's complicated now by the fact that we don't know the path of the virus or when we're going to have a vaccine. But I would say it's probably going to be more like a elongated stair-step recovery, because different geographies and different industries are going to come back at different times. And the industries that are most influential to oil demand, of course, would be transportation industry, because we have lost mostly gasoline demand and jet fuel demand. So they probably will come back later. Certainly the jet fuel will come back later because people are very worried about flying now. But eventually they will come back. And then the question becomes, do they come back to where they were before or not? And I don't know if you want me to go that far, or
Yes,
do you want me to?
I was going to ask you exactly just now about that.
Because that is probably a more interesting question.
What is what will be the new normal? What is the
And when do we see the new normal? Well, let me talk about it first without talking about electric vehicles, because that's a whole nother question. I've just said that the fuels that were hit the hardest were gasoline, which is 27% of global oil demand, and jet fuel, which is 7%. And that's a third of global oil demand. There's a lot of people who are saying that the demand for transportation fuels are not going to come back to where they were before the virus. Travel, reduced pleasure travel, fear of getting on cruise ships now, germs in airplanes, etc. Visas are more difficult to get. Rising nationalism, particularly in countries like the US. The fear of quarantine and not being able to get home if you do go somewhere. So it's going to take a long time. First of all, you're going to have to feel safe that there's a vaccine before you're willing to get on high density airplanes again. But also, you'll think twice about it. For businesses, we're virtual meetings, the meeting we're in now, we don't have to be together in person. This technology is simple. Everyone knows how to use it. It works very well, and you save the travel costs. You can work at home. Everyone's getting used to working at home. You will use more electricity probably, but less oil. Teleshopping, more internet sales, and deliveries could be done by trucks with diesel fuel. So again, not gasoline. You could in the future have robots or drones delivering your goods, which probably means electricity. Of course, you'll have less gasoline use if people aren't driving to stores as often. Deliveries could also be optimized for efficiency, so you will use less fuel than if everyone drove themselves. Grocery delivery services, I understand Uber Eats global bookings have risen by 50%. So, the world has really changed. Commercially, I would expect to see reduced complexity and length of supply chains. A lot of the solar panels, putting together computers and bits. A lot of people were shocked by the supply chain breaking down, particularly in China, when China was hard hit by the virus. 3D printing close to the market. That was a trend that was already occurring, but this will actually increase that, because then you don't have to depend on a supply chain from somewhere else. You print it where you need it. And of course, that means less fuel use. Production of some items from our manufacturing are going to be viewed in the national interest now. It could be ventilators, it could be some other manufactured good. So countries will want to have those things produced at home. So being a two-handed economist, I'll now give you the exact opposite point of view. I could make the case that some of these factors caused by the virus could actually increase oil demand. And I think the difference of which case you get is what government policy and how it plays out. But let me give you some of the factors that suggest that oil demand might increase. I mean, obviously in the short term, it's going to be lower, but how it might increase, if you have periodic viruses like that and it takes time, or you don't ever get a vaccine, and this continued phobia of being close to strangers, you will stop taking mass transit, and you will take something that requires a lot more fuel use. You'll stop ride sharing. You won't do ride sharing. Ride hailing, you probably won't do that either, because you'll be worried about getting into a strange vehicle. So it would mean greater use of personal vehicles. And that is exactly what transportation policy planners are trying to stop in terms of limiting transportation demand. But the real kicker to me is, are people afraid of living in cities, be it New York City or Mexico City? Do they reverse the trend that has been taking place for years and start moving out of the cities into more rural or suburban areas? Because because of the fear of the virus, but if they do that, they're likely to drive more because they'll be in places where that's the only alternative. Finally, vehicle ownership. With lower oil prices, I think consumers are going to likely buy larger and less fuel efficient cars. And of course, that will mean greater oil demand. More frequent Amazon deliveries. What if Amazon Prime was a 2-hour delivery instead of a 2-day delivery? Because everyone's now becoming dependent on having everything delivered. So you could see that you can make a case in either direction, and it really is highly uncertain. And I think the thing that would switch you from one to the other would be government policy, and probably not even national policies. I think it might be set by city or state and local policies in many cases. So Aldo, I don't know if you wanted me to stop there or talk about electric vehicles, because
I was going to ask you about which two hands was heavier than the other. Where would you put your bet in terms of the scenarios? I know it depends on government policy, but where do you think this might be going?
Well, I mean, the government policy that would make the difference, I think, would be carbon policy and clean air policy. Those are the two policies that would make the difference. And so if I knew that there was going to be greed incentives, and we are not putting carbon aside because we're worried about this and jobs and the economy, and we're going to continue where we were a year ago, I would say it would be less oil demand. But given that it's hard to get people focused on climate when they don't have a job and the economy isn't growing. So right now, I think it probably would lead me to the conclusion of greater oil demand, but it's going to depend on how quickly the world economy snaps back, because I think we will go back to our concerns about climate change after we get out of this really dire period where people are just worried about having jobs and food.
But what's clear in either scenario is that there will be a new normal. The normal,
absolutely.
It will not be there. We will have an economy that either optimizes on, let's say, on transportation, that probably is more regionalized around the planet, so that some industries become again more local. There's more domestic production, certainly now, for example, of health goods and things that are required to attend this pandemic. And people will probably be for a while more isolated. It seems that this tendency to be using cars more than public transportation will be reinforced, and will be there for a while until people begin to feel comfortable again amidst crowds and the rest. But let me ask you now something, still staying in the short term. We've been talking about demand, and I am right now in Texas, and the LBJ school is in Texas, and everyone is asking about how will the oil industry fare? What about all those jobs? How will adjustments take place for the oil industry? We know there's demand destruction. We know prices are already sending the signal to companies that they should be reducing production. How do you see this process that right now does not look so orderly despite the agreements that we're seeing from OPEC Plus and other countries? How do you see that unfolding in the next weeks or months?
Well, the first thing is, I agree with what you said. This is not an orderly process. Usually there's a supply curve, if you will, of costs, of cash variable costs. And if you lined up all the production, you would shut in production based on the highest variable cash costs first. We're not necessarily seeing that today. And it's because storage is so full, particularly if you're inland, either the storage is full or the pipelines are full. You see tight oil, US tight oil, being shut in, which is one of the lower cost supplies, not as low as, say, Saudi Arabia or Iraq, but in a variable cash cost basis, it's fairly low cost, yet you're seeing a lot of it shut in, and it's simply because you can't get it to the market. So we're throwing out economics and merit order in the supply curve, and we're now actually shutting in production that just can't be delivered to market. Any country internationally that sells on the spot market, as opposed to having long-term contracts like Saudi Arabia, will have trouble selling. Russia, I imagine, is having trouble selling oil because I understand their storage facilities along their main export pipeline are pretty full. So it's almost like a hodgepodge, disorganized fashion, just depending on where you're located, who is shutting in production now. So the US and Canada, I think, are going to bear the brunt of it because they're mostly inland. The Permian, Bakken are inland, and they are definitely being held up now by, ordinarily they actually do have a lot of oil pipeline capacity to get out of the region. But because pipelines are now sort of being used as storage, you just can't get it out there. So yes, I think we're going to see between maybe 2 million barrels a day or higher US production being shut in now. And it's a terrible thing for companies. I think we will see some bankruptcies, but some of the larger companies are actually not in as bad shape as you may think, because a lot, 2 years ago, a lot of companies did not have positive cash flow in producing US tight oil. They were spending more than their operating cash flow, and that obviously is a model that can't continue. But over the last 2 years, the investors have decided instead of getting production growth, what they wanted was returns. And that has really changed the behavior. You hear it called capital discipline. I think that's changed the behavior of the industry such that even before this virus happened or the price downturn, they had already been cutting back on the amount of reinvestment they're making. And a number of them had positive cash flow by the end of 2019. Also, there's not a lot of debt due this year, coincidentally, versus the next 3 or 4 years. So I don't think the industry is in quite as dire straits. I mean, they hate to hear, when you have to lay off people, you are in dire straits. So I put that on the table, but put it aside. It could have been a lot worse if they hadn't instituted this capital discipline and sort of gotten the financial house in order. But the attractiveness of the resource itself, and in terms of cost, it's sort of in the middle to lower end of the cost curve. There isn't there's not an investment that for the public sector can invest in that is as attractive as that. A lot of the OPEC investments are not available to many companies. So I would say that people will come back to this. It will grow again. And all it takes is investment. And the industry reacted very fastly now. They cut their spending very quickly. They pulled rigs down very quickly, much faster than they'd responded in the past. And I think they'll be able to respond upwards on the other side. You may see a reorganization. Some of the smaller players might not make it. They may have to file for bankruptcy if they can't get financing. But the resource is good and it will get investment. There may be some sort of reorganization in the industry, but it's a good resource. It's going to come back. Now, what you won't see is historically when it was growing at 1 to 2 million barrels a day per year, that was the period when they were over reinvesting in it and getting very poor returns because they were being incentivized to maximize production growth. Now that investors are not incentivizing them that way anymore and investing them for returns, you will see much less investment rate, and therefore US production is going to grow at a much slower rate in the future than in the past. Maybe 200 to 400,000 barrels a day per year, as opposed to the 1 to 2 million barrels a day per year.
Would this be a scenario like in the crisis of the 1980s? By crisis, I'm referring to the prices that declined so much by 85, 86. It took about 10 to 15 years for production to go back to the level where it was
Yes.
in 1981, 82. Could we observe something like this time?
Well, the reason why it took so long then is because at least in the US, it was very mature. It wasn't until shale production came along that you could, economically add a lot of resources and production in the U.S. So no, I think it will come back very quickly, and as soon as the price dictates it, it will come back. In fact, you shouldn't put in any. What's that? I'm sorry.
This is owing to the flexibility that shale production has, as opposed to other.
Right, very short cycle time. So within 10 months, you could turn this around. You can't do that. When one thinks about non-OPEC production, one thinks of a cycle time of 2 to 3 years, maybe even 5 years for deep water. And this is something that can be turned around within a year. I mean, it's not like OPEC spare capacity, which can be, put up or down in weeks or months or in a very short time period. No, this is not like that. But within 10 months, you can certainly ramp production up or down. And, the question is, can you get the people who have been laid off back in the companies fast enough? And that, to me, that will depend on what the rest of the economy is doing. If the rest of the economy is strong, it will be hard to find the people. If the rest of the economy is weak, it will be easier to get people to come back. But so no, I don't think we're going to see that at all, but we are going to see a much slower rate of growth. And the rate of growth was growing at a level higher than the growth in world oil demand, clearly creating problems for other producers and for OPEC. When production comes back, it will be at this slower rate, which happened really before the coronavirus. This is about capital discipline. It will come back at a rate that's much more manageable in the world market. It won't grow at a faster rate than world oil demand growth.
So in principle, in the last 10 years, we have had 3 price drops that have been very drastic, right? So the one that followed the financial crisis, the one of 2014-15, and now this one. Presumably the industry now does have this much present as part of lessons learned, and the capital discipline that you referred to will be here to stay for longer. Right?
I think it will, although one could argue that the financial community is very fickle. And if you were to see a spike in oil prices, would they start encouraging production growth again? And I don't think they should, but the question is, what would they do if we were to see that?
What are the alternatives? So now let me go back before taking some questions from the audience. I have some here in my screen, but some of them are also related to what I will be asking you. Let's go back a little bit to think about the future. Part of the future you imagine has to do with mobility. There's either lower or more mobility, and the equation, even if there is more individual mobility in cars, involves electric vehicles on the one hand, so I would like to hear your perspective on how much of a dent this type of vehicles will be making on the car industry and the car market. And number 2, the other question is, where will this electricity come from? There's a lot of interest on renewables, and whether we're going to have, as I showed in some of this in the graphs, a greater participation of renewable energy sources, wind and solar, in generating electricity. So how do you see those 2 trends going?
Great questions. First, just to give you a context, in 2018, there were 5 million electric vehicles in the global auto fleet, which is 0.5% of the about 1 billion car fleet, and China's half of that. We saw great global EV sales in the first half of 2019. There was about 1 million of them sold, which was a 46% increase. So it was rising rapidly before the coronavirus, but from a very low base. The reason why it started to rise is battery costs have declined. So they're almost within shouting range of becoming competitive with the internal combustion engine, and supportive government policies, specifically in China, Europe, and California. So it's every year for the last year at Columbia University, we've done a survey of all the different forecasts of electric vehicles. And what we found was, by 2030, the range of views on electric vehicle penetration was of EV sales was between 5 and 55%. And the difference was whether or not there was a lot of climate action or carbon policy. You saw a similar thing in terms of how many EVs in the fleet, but that's much slower to change because it takes like 20 years to turn over the global auto fleet. So the range of penetration in the global fleet was between 3 and 26%. Again, it depended on the carbon policies. But there was a slight twist to that also. There's some of the forecasts that did not have a strong carbon policy had high EV penetration because they believed that electric vehicles were going to be the primary driver in ride-hailing services and in ride-hailing autonomous services, and therefore they would have a disproportionately large amount of the vehicle miles traveled and therefore affect demand more. So, you know, that's what people were thinking before this crisis. The immediate response to to COVID-19 is global EV sales are likely to plunge by over 40% this year. So it's definitely having a negative short-term effect. And when you think about it, in economic recessions, people don't buy cars, let alone electric cars. They just don't buy cars. And if it's a very low oil price, there's less of an incentive. You know, I said because of the lowering battery cost that it was becoming more competitive with the internal combustion engine. Well, having a low oil price moves you away from that. The auto industry, I think, is going to struggle to roll out new models. They're having an auto recession, you know, is more specifically, which probably started before the coronavirus. And now we see Ford and GM making ventilators. So, I mean, this is not a time to be rolling out new cars. Plants are closed. The Tesla plant in California is closed. And, you know, people really don't worry as much about climate when they're worried about dying and they're worried about having a job. Longer term, though, I think there's a greater possibility for EV penetration going back on track. There really are, there's probably pent-up demand for automobiles, certainly in developing countries, maybe not in the advanced economies. It was very interesting to observe that in Wuhan, car sales, you know, now that Wuhan has come out of isolation, car sales now are the same as they were last year. Isn't that interesting? I would not have guessed there was that much pent-up demand for cars. And I'm talking about regular cars, not electric cars. And I believe it's because people are afraid to take mass transit now. So that goes back to my argument before about how people will actually buy more personal vehicles and they won't want to take mass transit. But now when you have a declining battery cost and when the oil price does recover, EVs could become actually profitable for automakers and they would be more anxious to move them forward. Europe still has more stringent tailpipe standards coming in. China has a great desire for clean air. So I think government policies in both those places are going to still be supportive of EV penetration. Consumers may decide they like EVs. They may like the fact that the acceleration is very fast. There may be government's green incentives as part of economic stimulus package to either build infrastructure or put electric vehicles in place. Even candidate Biden for president in the US has strong support for building EV infrastructure. Interestingly enough, in China, the Guangzhou government just announced plans to support electric vehicle usage, which you would not have expected in this environment. This shows that these governments are serious about this. But here's the one that's the most interesting to me. You know, I've had a lot of people tell me that, you know, who live in Seattle, New York City, that they're seeing things, they're seeing New Jersey, they're seeing faraway places that they've never been able to see before. People are discovering what clean air is really like. And I don't think they're going to want to go back to a world where the air is dirty. So I think the cities actually are going to be the big drivers. And I know in the US, Los Angeles, several cities would like to require that ride-hailing vehicles only be EVs. There's certain legal problems with that, and that the federal government has dominance on policy when it comes to fuel efficiency. But the point is, when people discover something new, like they don't have to travel for business if they can, you know, do a video conference, or they can have really clean air, I don't think people are going to want to go back. So I know that was a long answer, but, the next question was, where's the power going to come from?
Where's the power going to come from?
Yes. And I think that a lot of it will come from renewables. What has to happen, though, to make that happen is that time of day pricing for power. You have to have that. Because if everybody came home from work and charged their electric vehicle in the same time, you would double or triple peak power demand, which obviously doesn't work. It would cost a fortune to make that much generating capacity. However, you may not even need to add much generating capacity if you could force people to charge their vehicles in the off-peak time for power. In fact, I would say that most of the investment required to have that happen would be more in the transmission and local distribution infrastructure and less in the generation capacity, if you can move around the time of day that people charge their vehicles.
So this is what's striking to me about this perspective is that a lot of it depends also on policy, beyond
Yes.
beyond the habits that might stay and the habits that are changing, and even the aspirations of people, and certainly the new generations for a cleaner energy system. It seems that to get there, we do need the support of policy.
Yes.
And this matters to us a lot at the LBJ school. It's a public policy, public affairs school. Where would you put the emphasis in order to make the transition toward this cleaner energy system? You have mentioned that a lot of this depends on what city governments will do.
Right.
What about national policy? Is there space for an industrial policy that that strengthens and develops or expands the supply chain for clean energy? Where would you put the emphasis for these policies?
Well, my issue is that I'm most familiar with U.S. policy, and right now, U.S. national policy is reducing the fuel efficiency limits. So it's sort of moving in the opposite direction. So I would say right now in the U.S., the impetus is on the state and local level in terms of policy. But in other countries, you still have national policy. And China is an interesting example of a country that has done multiple policies to get people to purchase EVs. And with them, it's really more about the clean air and the unacceptability of the air in some of the cities. So they've done things like you have to compete to get a license plate unless it's an electric vehicle. They have a low emissions vehicle policy like California that says that you can't sell any cars in California unless a rising percent are electric vehicles. That's a very effective policy because they're a quarter of the global auto market, and all the auto manufacturers want to sell in China. They have policies saying you can't drive into the city, more than a certain days a week unless it's an electric vehicle. So they are really, making it a compelling case. And also they did also have a tax incentive, but the tax incentive backed away at a certain time. And the reason why is they intentionally did that because they wanted their own domestic electric car industry to stand on its own and be competitive. So they purposely did that. I think a lot of people misinterpreted them taking it away as saying they're no longer in support of it. I don't think that's true at all. I think
what we're seeing then is one of my takeaways here is that, the two-handed economist, we have price trends and consumption trends that suggest that an increasing consumption of gasoline and fossil fuels, but we have still the growing concern for the climate, even though it's now suspended, and policies that are in place in many countries to promote greater penetration of EVs and greater use of renewable energies. And it's always hard to predict what's going to happen, but I think you have given us already, and I'm certain you have given us very interesting factors to be looking at how they evolve to better understand the process of change in the energy industry. We are basically at the limit of time for our conversation. And I would like to thank you very much, Marianne, for your insights. It's always great to hear you. It's always very interesting. And I would like to thank also the audience for joining us. We look forward to seeing you next week for our LBJ in the Arena discussion of modeling COVID-19 and its policy applications.
Oh.
In that case, yes, this is part of a broader set of conversations about what COVID means and how policy will change. And of course, the LBJ has a lot to say about it. Dean Angela Evans, in this case, will sit down with Dr. Lauren Ansel Myers, a professor in the Department of Integrative Biology and Statistics and Data Sciences. Dr. Myers has been at the forefront of modeling COVID-19 outbreaks and informing government agencies such as the Center for Disease Control and Prevention and the White House Office for Science and Technology. She will discuss the immediate and long-term risks of the virus and engage in a conversation of how policy, again, policy and science, and one should emphasize, and science have interfaced in the COVID-19 context. We can never emphasize enough the importance of methodical, systematic thinking, facts, and sound policy. So thank you again, Marianne, for joining us. We are
It was great to see you.
And I look forward to continuing the conversation. Thanks again.
Thank you.